Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me on the program today is returning guest Frank Holmes. He's CEO of U.S. Global Investors and CIO of their funds. How are you today, Frank?
Outstanding in San Antonio, Texas, where it's 100 degrees.
Sounds a little better than the rain that we're getting in Calgary, but I guess that's the roll of the dice. As we've seen lately, gold has been rising for the last 18 months, and something that you had an article on recently was the Golden Cross. So could you explain to us a little bit about what that is and what it means going forward for the gold sector?
Sure. You know, when I first got in this business, there was no real charting computer or internet, and it was a book you used to get, a weekly charting book, and it was important to take a look at they call the 50-day and the 200-day. And the 50-day was basically 10 weeks. And you were comparing to 10 months. So the thought process was based on analysis that when the 10 weeks was above the 10 months, that was a secular trend. That was a bullish trend. And when it went below, that was the end of that golden cross. So now it's all computed with 50 days and 200 days. And we can get it in real time almost. And what's important for investors is that it attracts institutional money. They're risk averse. And when that golden cross took place 18 months ago, all of a sudden we started seeing a lot of hedge funds come out and billionaire hedge fund managers coming out and saying, you know, they like gold and giving their rational reasons why. And it relates to this idea that the wind is at their sail, not in their face. So if the 50 days below the 200-day, you don't see many names like that being contrarian, saying it's going to go higher before it goes low. No, they want to have the wind at their sail. And what's nice is that the wind has been at our sail for almost 18 months, and we've had some great corrections, but never did the 50-day fall below the 200-day. Gold might have fallen below the 50-day average price and then bounces right back. The overall trend has remained constructive, whereas most people have been negative on gold as an asset class. That is a great bull market, and it reminds me of 2001, that period when it ran all the way to about 2007. We had this beautiful long run in the price of gold.
So considering the recent price action, and we've hit, I believe it's like a 9-year high, again, we've broken through that. What are some of the factors at gold's blowing in its sail?
Well, there's many of them is growing. We saw a rebound out of China, and China and India, which is 40% of the world's population, are very significant players, and I always like to talk about the love trait, the cultural affinity to give in gold for marriages, for birthdays, for anniversaries. And so what you've seen is the rising GDP per capita of China and India really was a non-event 30 years ago. But today, they're ranked in the top 4. And so what does that mean? Well, if we go back 30 years ago, the demand for gold, for love, out of those two countries was about 10% of the consumption of gold. Today, it's 51%. And so that's very important because that's 60% demand. And we've seen China do everything. It's how a ramification now for copper. We get a strike in Chile, and all of a sudden copper is hitting a 2-year high. Supply restrictions, but they're building out and picking up the demand in China. So China is also 50-some-odd%, 53%, I believe, of commodity demand. So what their economy is doing is very important in the amount of money printing. And what we see here is that when the money printing takes place, it rolls back into stocks. It blows back into the economy where people are hungry for yields. So I look back and say to you that it's important for investors to recognize that 60% of the demand for gold is love, 40% is fear. That fear trade is negative real interest or zero and excessive money printing. And what's happened in particular since 2008-9 crisis is that the G20 finance ministers and central bankers function as a cartel. They don't really compete with each other. They're synchronized. Back in 2002, they were synchronized in global trade. Then after 2009, they became synchronized in global taxation and regulation. And now it's synchronized about economic stimulation to get the global economy going. And this excessive money printing is showing up in real assets. And we're seeing that, no doubt, in gold. And interesting for your readers and listeners is that last year we had a great rally in 2019 till August, and you could easily see when you look at all the government bonds around the world, as more and more went to negative real interest rates, the price of gold was ratcheting up. That peaked in August, gold sold off, and now it's on that trend back up. So I think that we're listening to Powell speak a couple of weeks ago, and he said forcefully and aggressively they will push everything they can to stimulate this economy. So I mentioned at the beginning of this year it's going to take about $10 trillion. The last time the Fed balance sheet got expanded by $3 trillion, this time it's going to be 10. We're at 7 already, and they're talking about several more. And rates are not going to rise over the next foreseeable future. So I share with investors that there's a really strong demand cycle for gold, especially when you have negative zero interest rates around the world. I expect gold to be the best currency going into 2021.
So, Frank, in your opinion, will we see $2,000 gold this year?
Oh, yeah. I think it's very, very, it's in the cards. There's no doubt. It's in the cards. A lot's going to happen between now and the election cycle. And it seems that not only is the media in America anti-Trump and the White House, so is most other countries around the world. And I think that, that big battle is taking place. So everyone's pushing to see what they can do to spend money to get reelected, and or for the incumbent to come along as Joe Biden come in. And I think that those dynamics are just going to allow the fear element of more money printing that would be normal and usual.
Excellent. In doing a little bit of research for today's interview, Frank, one of the things I came across, you were saying that the futures market is a risk on the price. Could you explain it to us a little bit more about that?
Well, the futures market is a hedging mechanism for users and suppliers and buyers. But what happens here is that also lots of financial engineering and trade wars happen up in the futures market. And the leverage can be 20 to 1 to 100 to 1 at times. But easy, let's say it's 20 to 1, even 10 to 1. And you can't get more than 2 to 1 margin on a stock. And here they have to put up very little capital. And there's been several lawsuits. Judges are now waiting to, it's an ongoing process for those that got charged for LIBOR and for gold manipulation and spoofing the market. So you can see through the big banks, and maybe they probably get cohesion through central banks, is what's alleged in the marketplace that there's something that's there, because now in courts they've disclosed and proven that there's manipulation in the futures market. And still, no one has been sentenced. It's interesting to me to watch that drama unfold. I do know, in listening to the head of the commodities exchanges saying to a group on Crypto World that Bitcoin futures market was fast-tracked to put a lid on Bitcoin. The government and banks, and so therefore they don't have to disclose. They don't have to have if one bank is 50% of all the shorts, that's not really disclosed as one bank. And so that's when you hear those stories, you say, wow, you just have to be, if you play in that arena, you have to make sure you have instant liquidity, and you have to recognize that it can be a mug's game. And it's not like stocks, I think, are much more reasonable, and there's much more transparency and disclosure.
Frank, as we were talking about China, one of the other things I wanted to ask you is that as we see China trying to build their currency into something that will compete with the euro and the US dollar, and they're trying to back it with gold by continuously buying physical, does this also create more of an upward demand on the price?
I think to a certain degree, but I think the more worrisome part will do that is that America's military expertise and its strength is way, way ahead, and China's spending more money on military and expanding their footprint. Like in Sri Lanka, they have a massive naval base, and they helped stop the violence they had in that country over a decade ago. But they are no doubt building islands in the Pacific. They're expanding their territory. So they realize they have to spend on military. And I think that that's one of the things that will scare markets, but will probably have a positive impact in bullion. And what your listeners have to recognize is that the greatest bull market in stocks, gold stocks in particular, is when you have both gold rising and the stock market. And that's what we had from 2001 to 2007. We had a wonderful move in the price of gold from $260 up to $800. At the same time, the stock market was buoyed and trading higher. That really added to the interest and fascination in junior exploration. And so I think that gold bugs have to be really careful, because a lot of the gold bugs I listen to, actually they like gold stocks. But you have to be bullish on stocks too if you really want to make the big score.
The reason I was going to ask you that, Frank, because as we saw the recent kind of controversy out of China with the copper bars that are just coated in gold, do you think that will help erode some of the confidence in what the Chinese are doing?
No, I just think it makes a culture. It's a culture that of that type of corruption and accountability. What will be the accountability? If those characters have high relationships in the Communist Party, then they could probably get off. Whereas here, when there is corruption, the court system is very diligent at going after and reprimanding bad players. The issue there is it's China, and they're corrupt, and they're bagging their own people.
Interesting. Frank, as you're talking about, stocks moving up as well as gold, let's talk a little bit about why royalty companies in particular are so attractive to you.
Well, really you have to start at the beginning of the business model. It's like a Betty Crocker cake mix. It's a superior cake-ready mix. Now, your mother probably cooks a better chocolate cake, but if you want to go to a recipe that becomes mass appeal, there are certain business models which are superior. And one of those is the SaaS model. And the SaaS model is recurring revenue. And it's very stable, non-volatile recurring revenue. And what happens in the quant world, the quantamentals, in stocks, etc., there's a higher valuation on revenue per share and cash flow per share and earnings per share for SaaS stocks. When we look at a royalty company, they're very much like a SaaS stock. And when you look at just the financial, forget it's gold. Just look at their flow of funds, how stable they are, even with gold being volatile. Royalty companies' revenue and cash flow is much more stable than a big gold mining company or a mid-cap gold mining company. And I think when we look at SaaS models, they usually have high gross margins. Microsoft has high gross margins. So does Franco-Nevada. Newmont doesn't. Barrick doesn't compared. So when I look at the universe of gold stocks out there, the average gross margin, I think, is something like 18%. And when I'm looking at royalty companies, we're talking over 50%. Streaming gets accounted differently than the pure royalty, but if you look at, say, Franco-Nevada, and let's say they do $500 million in revenue, their G&A is $50 million. That means $450 million is basically free cash flow unless they invest it. That gives them ability to increase dividends. And the other thing you look at, say, the Franco-Nevada, it has the royalty in Nevada on Barrick and Newmont's operations. Well, the Franco-Nevada has over $24 million of revenue per employee. Goldman Sachs is over $1 million. They're $24 million. Barrick and Newmont are $600,000. So you have much more efficient use of capital with a royalty company, and so they get rewarded for that. So you still get the rising scenario. At the same time, you get less corrections because of the currency. And you're also seeing that the Ray Dalio, the largest hedge fund manager in the world, and you see the quant people that have the top performing quant funds, they own royalty companies. And then they'll go look at a Barrick or they'll look at a Newmont because it's liquid. But one of the things that's interesting is that the Barricks and Newmonts, and I'm seeing Yamana, I'm seeing other gold mining stocks coming out with, well, we have free cash flow. And that's what's really important to get the non-gold fund manager. The generalist will go into a stock when it has free cash flow. And what happened is that for the past 3 years, the gold universe of 100 stocks we follow still had negative real interest rates as a median of all of them. And what was interesting was that this March of 2020, with the coronavirus, is that the S&P, which had a 2% free cash flow yield, evaporated, just gone. And gold stocks went positive. So all of a sudden now we're seeing, and especially from the bottom lows in mid-March, the gold, we know this from GoAU, our smart beta, it's a quant approach to picking gold stocks. It far outperformed bullion, like far, in that bounce from bottomless in March. And so I think that's a very positive sign because we're going to get more and more generalists coming into the space. And that's important for the ecosystem of gold stocks. And as long as these gold producers, mid-cap to big-cap, demonstrate a revenue per share growth, cash flow per share growth, and don't do stupid acquisitions where they destroy that value on a per share basis, they will start continuously attracting a higher valuation. The royalty companies, they're even in a premier position because their model is a SaaS model, and it always gets a higher valuation by the generalists.
So, Frank, one of the considerations that you were talking about on some of the juniors is kind of one of the things that you were talking about was that they're not going to be participating in the upcoming bull market because of some of the ESG considerations. Can you shed some more light on that for us, please?
Well, I think the ESG is really important, but the thing is, gold mining stocks have always had high community relationships. They've always been published them. But ESG has become another European socialist word. You know, they play games. The words sugar-coated, meaning one thing, but really it's where these failed socialist policies they have are now basically putting that burden on mining companies. But the mining companies have already been doing it. What they've embedded in that has been the carbon footprint because they want to go after anything as a carbon producer. So operations in Panama that uses a coal mine, automatically they're going to have a low ESG. It doesn't matter the Cobra project, they're using coal, so it's automatically bad. That is very much understood as an EU socialist policy, and the BlackRocks all comply because they want to get their big pension funds. They want to get the Norwegian $1 trillion pension fund to be able to manage. So it's recognizing that it's just a new buzzword. It will create more challenges for these mining companies, but it really drives higher commodity prices. Because if companies can't explore or can't develop and can't increase their production because of this ESG issue and it's imposed in such a degree, then supply is going to be restricted. And that means you're going to get higher commodity prices. So then you're going to get inflation in that sector. So I think there's no doubt the ESG is going to lead to higher commodity prices, and it's going to be a distraction. More important for the junior explorer, if all of a sudden they have to go into another layer of spending, because how many people are going to speculate if most of the money for junior financing is going to ESG issues? You're not going to be able to track that speculative capital. And so that means you're going to have less discoveries.
As we're speaking here, it's mid-July, and we're looking forward to the upcoming commodities halftime report. Can you give us a couple of the highlights from that?
Well, the best performing everyone knows is gold, then silver, and then palladium. The commodities. Interesting, palladium was not positive for the first 6 months because of the car crisis due to Corona, but that's sort of making a comeback now. But I think that palladium's a great example. It's a case study of what happens when supply starts being restricted for many years and demand grows at only 2% a year, and all of a sudden in 2019, palladium goes from basically 1,000 to 2,700. You get that pinching that takes place. Well, copper's in that position. Gold is at peak gold. So I think that it remains very, very bullish for these particular asset classes. But the big part is for exploration is what's going to happen to attract new buyers and speculators. I have mentioned several times, several years ago, that the crypto space basically became its own ecosystem, and all these young millennials that made a ton of money on Bitcoin were rolling over to new cryptocurrencies, and there was like $5 billion that went into speculating on new cryptocurrencies rather than junior mining or technology. And the big reason for that is they could trade 24/7. There was always a new story. But that game's gone. And I think hopefully that we'll start seeing some of that speculative money coming into junior mining because it really is high-risk capital that does exploration.
Frank, before the call, we were talking a little bit about the Jets ETF, and you shared with me something that I've frankly found quite surprising. And so why don't you share with us a little bit about that story and how things are actually really a lot more positive than one might suspect just on the surface?
Well, I think the biggest thing is for me, from a big picture and looking at other, besides my airlines ETF Jets, is the ecosystem. A healthy, vibrant ocean where the Great Barrier Reef is. On the outside of that is where life is most vibrant. Colors, the coral, the vegetation, and a whole set of different fish, from little tiny minnows up to whales, great white sharks, tunas, you name it, eels. They're all there. And the ecosystem for the stock market needs minerals. It needs to have where people can come in and feel they can get the American dream. They not made inventing, but they heard that this is the new Apple or this is the new Tesla or whatever. They want to be able to speculate at that end of it. And you're seeing with ongoing regulations and interpretations, and most important is regulations like the fiduciary rule that came out of Europe, how it was interpreted in Canada, how it was going to be interpreted in the U.S. They're all very different. But what it did do is it basically chased away speculation and said you can go to a casino or you go to the racetrack to speculate, but not in stocks. And I think that what's happened with the coronavirus is that we've had all these millennials that are stuck at home, that are more educated, more internet savvy, and they start becoming day traders. And some became tactical traders. They learn from YouTube and from listening to podcasts, as my research has found out. And I know that in the month of March, there was a press release put out by TD Waterhouse and Schwab that they both brought in 600,000 new online accounts, and supposedly Robinhood brought in 2 million. Now the Robinhood accounts are a lot smaller. They're like $2,000 versus $10,000 for, say, a Schwab account. But what's really important is that we had more money come into the market at the bottom from millennials than there were stock buybacks. And something like 60% of the checks, these working professional millennials working from home, that all went back into the stock market, which is really profound. It reminds me of the 90s when all of a sudden everyone started investing in mutual funds and everyone was going into 401ks. There was a huge savings and investing paradigm that fueled the tech boom. And I think that this is so important coming at this time. And what we experienced is I got a call from Eric Buchanan that said, who's the head guy, Bloomberg, leading ETF strategist. And he said there's 3 ETFs out there, Nigeria, coal, and Jets, the cheapest in the space in the world. Why Jets? And I thought it was most interesting because that was almost at the bottom where you saw money started coming in through Robinhood. And Robinhood allows you to be able to track. There's another service that's out there to track the number of accounts. And we basically went from a couple hundred accounts to now it's like 40,000. And during that whole period of March and April, while airlines was bottoming, over 20,000 of these Robinhood accounts coming in. I was told, the number might be 30,000 came in that time period, and then it took off after Buffett announced that he was dumped everything in the airlines, and then IBD came out with the headline that Buffett left $2.7 billion on the table. And it's interesting to watch the Jets rallied about 57%, then corrected, which is now in that phase, and it's very sensitive to Corona news. But I think what's happening is that we saw this huge inflow, and I went to the Robinhood site. And it's interesting because the toolbar at TD Waterhouse does not include gold, and the toolbar is Schwab, but at Robinhood it does. So there's a greater interest in gold as an asset class, and I think that is probably a positive paradigm change that's taking place. And during a 70-day run, which I was told by Eric is unprecedented, it never happened before, we had over $1 billion come into Jets ETF before it took off. So it's volatile. The airlines industry has always been, the stocks of the airlines is more like gold stocks, the same level of volatility, and emerging markets and biotechnology. So I think it's a fascinating new chain, and we saw a lot of tactical people that were shorting airlines and then want to hedge themselves by going long Jets ETF. We saw people that started flowing in because they did analysis that after 9/11, 6 months later, the airline industry was up 80%, and after the SARS in 2003 pandemic in Asia, they were up 120%. So this analysis is being done by these young millennials. And then after 2009, they were up 80%. So they're all speculating that this can pop 50% in a short period of time. So these are all really bullish things that they're doing their analysis. I warn people that it's very speculative. You put your seatbelts on before you invest in the airlines ETF, just like I say on junior gold mining.
So what are some of the other ways you think that we can get some attention paid to by the Robinhood traders in the gold stocks?
Well, I think it's quality YouTube presentations, not people hysteria and full of few nouns and lots of verbs and adjectives. There's some real facts. And there's some guys that do a great job. His name is ALE. He doesn't do gold stocks, but his process of communicating regarding why Google is interesting or Boeing is interesting or not interesting for him, he has a nice presentation. And you meet some of these young people, and they have tens of thousands or hundreds of thousands of followers for picking stocks and looking at it. So I think education on what drives a gold stock, what drives an exploration success story, I think things like that will be very, very helpful for investors because Robinhood people are going to find them. And the other thing, as I mentioned earlier to you on the call, was guys like Sam Chu. Never heard of him. On YouTube, he has 2.3 million subscribers. Another young kid, DJ Aviation, which surprised me, in a 3-minute video, is very informative. He has 290,000 followers. He's 19 years old. He's been in the business for 2 years. So these new investors and traders and the millennials coming in, they're very informed. They actually know the difference between the 777 MAX, what the problems are, what the better routes are. They talk about why, I mentioned to you earlier, Anchorage became the busiest airport in the world in March and April. Why was that? Well, we know everything shut down here, but they had to move medical supplies from Asia to North America. And so what you saw is also the price of gold, physical gold. Usually physical gold goes from Delta, from JFK over to London, and it costs $30,000 to move this physical gold, and all of a sudden had to go privately. It was $300,000 because there's no one was flying commercially. Well, what did that do to the price of gold? Physical gold, $135 over an ounce premium. So it's interesting to me. All this stuff is on YouTube.
Excellent, Frank. As we wrap up, is there anything else you'd like to add?
Yeah, and these juniors that are going to come out, just make really conscientious about corporate governance. That these young executives that are out there, that they respect the shareholders and they respect the process of corporate governance, and not just in form but substance. I think that's a really important part of it. And a lot of times when people bet on junior mining, they bet on the jockey and not the horse. So I've always had the discipline of looking at both. I want a great horse, a great geological footprint, a great technology, but I also want a good jockey. And so be very cautious about the jockeys.
Perfect, Frank. Let our listeners know where we can find more of your information.
usfunds.com.
Perfect. And also Bulldog Holmes on Twitter, correct?
Bulldog Holmes on Twitter. US Funds. I write about gold and other asset classes every week. My investment team puts this together with my marketing, and we do a SWOT analysis from gold markets to Asia to Europe. It's informative, and we try to make sure it's timely.
Awesome. Thanks for your time today, Frank.
Happy investing.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?